Selling your home and buying a new one, and today we wanted to talk about the pre-approval and finalizing your finance.
Right, so hey, you're selling your home, which makes total sense, and you're probably going to walk away with some sort of nest egg in order to buy the next home that you need. So you're not coming into this with 0%. Your home, your pre-approval is going to be probably a lot easier than other people's pre-approvals. Now, with this, we do have to talk about the basic thing, because it's been a while since you bought a home. So let's just talk about the pre-approval process again if you are going to go the mortgage route.
Exactly. Therefore, understanding the pre-approval is super important, but if you wanted to go a little bit detail, basically what a lender or professional lender is going to do for you is, first of all, they look at your credit report and see your credit score is good, and then they look at the verification of your income, your asset, and also overall financial health, which is your debt to income ratio.
Right, so basically that is the real details that they care about at the end of the day. Can you afford this new home? We're going to talk about a little bit more like the pre-approval process and different types of loans to consider, but we're going to do that after our introduction. Let's hit. Hey guys, Victoria, welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now, let's talk about the pre-approval formulas. Typically, people like to keep it. There's different. Maybe you want to go with the 28% of keeping your DTI to 28%. Maybe you want to go with the 36. A lender will typically allow 43. Some will go up as high as 50 for that debt to income ratio. So you really kind of have to come into this knowing how much debt, how much that monthly payment is you want is going to be. And of course, your credit score, 580 is going to get you FHA. Maybe that is not what you want. Maybe you want the better terms. So understanding your credit score doesn't affect too much your score that you're going to get, like the interest, because the government kind of sets that interest, but it will help you get that loan and help you become a little easier the higher your credit is.
Exactly. Therefore, your credit score is number one. The second one that is really important is your debt to income ratio, which is super simple. Basically, you have your income before taxes, like your gross income, and also then you add all of the debt that you have, including your personal loan, your student loan, your auto loan, every debt that you have, that sum it for a month, and then you divide it by your gross income before taxes, and it give you a number, which is the percentage my wife was talking about. But now we wanted to also talk about specific loan types and rates that is super important. And the first thing that comes to your mind is really a fixed rate versus adjustable rate mortgages.
Now, if you're going to stay in this home for who knows how long, I'm going to recommend always a fixed rate. I know some of these banks will give you an adjustable rate much easier, but that doesn't always work out in your benefit for the long term. So if you are going to be, maybe you are going to move in 3 years because you're in college. It's possible, but maybe you're not going to move in 3 years and then you're going to be stuck with an adjustable rate mortgage. So the question is it truly a fixed term that you're staying? And even if you think it might go longer, I would say try to stick with a fixed rate as much as possible, because you don't want to get into a beautiful home and have an adjustable rate and then have a problem with it.
Exactly. And most of the lenders, they use it as actually leverage when the interest rate is high, because they can really put you in the adjustable mortgage temporarily lower than the fixed rate in the market. Then you need to know what is your type. Is it 3 years, 5 years, or 7 years? And that's what the interest rate might fluctuate after that terms.
Now, the next thing is, there's different types. Maybe you are going to go with another VA. Maybe you're going to go with the FHA. Maybe you're going to go with conventional. Maybe we're only looking at USDA, but you're selling your home to buy another, which means your pre-approval is probably going to be dependent on that sale of that home. So I just want to point that out before we really got shopping, because this is going to give us our number to shop for. So maybe you're going from $200,000, now you're buying a $450,000 house. I'm just making up numbers right now. But you'll be able to understand what we can afford if a banker, a third party, someone who is really not going to go out shopping with us, but if they can tell us how much you're okay to sell, and maybe you are qualified for 800 but you only want to spend 400. That's completely okay because you want your debt to income ratio to be a specific number. So everything is possible. You kind of come to us with what you want, and the pre-approval process is the simplest way to understand what your budget is and what you're looking for and your budget needs are.
Exactly. In reality, the mortgage lender really using a complex mathematical algorithm that is embedded in their software, and basically they calculate the interest rate of your loan based on this model, which is your credit score is involved, loan to value ratio, the property location where you're purchasing, the amount of the loan, and also the loan type that my wife said 4 or 5 different type of loan. And we didn't even include the bank statement loan. Therefore, these are different types that might affect your interest rate.
I am going to add, most people who already own a home, and this is what the audience is going to have already gone through this once, and they've cared about their credit score once. So most of the people are going to have at least 650 when they go to buy their new one. So you're in a better financial shape than you think you are typically when you're already a homeowner. So that is something in your favor. I just wanted to add at the end. But I can't wait to talk to you about all of your needs. So don't be shy. Call us at 252-327-3357, and of course continue watching these videos above.
And don't forget to push the button for the subscription, and we will connect with you next